Hello everyone, let's start a new chapter of the Fundamentals of Financial Accounting course. Today we shall cover the chapter C1, Accounting for Current Assets, and in this chapter we shall cover the topics like accounting for inventory, accounting for accounts receivables, accounting for notes receivables, and bank reconciliation statements. First topic is accounting for inventory. Let's define the difference between service and merchandising firm. The service company is an organization or enterprise that provides service to earn profit. Here, primary source of revenue is service revenue. For example, a doctor, a professional accountant, an architect, they provide service and earn revenue. But on the other hand, a merchandising company is an enterprise that buys and sells goods to earn a profit. And a merchandiser's primary source of revenue is sales. So the basic operations in merchandising firm are that it purchases merchandises, that means it purchases goods, and sells merchandises with profit, and it maintains all office and sales activities similar to a service firm, and the recording process is no difference except for purchase and sales related activities of the service firm. Now we need to know what is inventory or how we can keep the recording of inventory. Inventory is defined as items of tangible property which are owned by the business and are held for resale in the normal course of business, in the process of production for sale, or goods that will soon be used in the production process. Here, ownership is determined by possession of title rather than physical possession and includes goods in transit if shipped, FOB shipping point, and exclude goods held on consignment. The accounting for inventory involves determining the current unit counts, comprising ending inventory, and then assigning a value to those units. The resulting costs are then used to record an ending inventory value as well as to calculate the cost of goods sold for the reporting period. Here, in case of recording the inventory in merchandising firm, we follow either of the two methods. One is periodic inventory system, another one is perpetual inventory system. Under the periodic inventory system, inventory records are updated only at the end of the accounting period by a physical count. Here, no real-time data about the levels of inventory is available, and obviously it is easy but less sophisticated. On the other hand, perpetual inventory system, here inventory records are updated at the time of changes, that means at the time of purchase or sales in inventory, and here real-time data about the level of inventory is available, and obviously it is more sophisticated but expensive. Now the question is, how can we measure the value of the inventory? Let's discuss an example. For example, you have bought 3 TVs. First one you bought on February 3 at Taka 700, then you bought on March 5 at Taka 750, and on May 1 you have bought Taka 800. Then you have sold 2 TVs, 2 sets on January 1 at Taka 2400. That means the selling price of each TV was 1200. Now the question is, what is the value of cost of goods sold, and what is the value of ending inventory, and what will be the gross profit? In this case, 3 scenarios may be explained. In case of scenario 1 or option 1, maybe you can determine the value of cost of goods sold. Let's explain an example. Suppose you have bought 3 TVs at 3 different days and at 3 different prices. For example, you have bought one TV on February 3 at Taka 700, then you bought another TV on March 5 at Taka 750, and you bought another TV on May 1 at Taka 800. Then on June 1, you have sold 2 TVs, and the total sales revenue is 2400. That means the selling price of 1 unit TV is Taka 1200. Now the question is, what is the value of cost of goods sold? What is the value of ending inventory? And how can we determine the gross profit? Here 3 options may arise. For example, under option 1, you may have sold the TVs which was bought on February 3 and March 5. In that case, the total cost of goods sold will be determined as 700 and 750, that means 1400. So the value of ending inventory will be 800, and the gross profit can be determined like sales minus cost of goods sold, that means sales is 2400 and total cost of goods sold is 1400, so the gross profit will be 950. But in case of option 2, we can say that yes, we have sold the TV which was bought on February 3 and May 1. In that case, the cost of goods sold will be 700 plus 800, that means total 1500, and the value of ending inventory will be 750, and the gross profit will be sales minus cost of goods sold, that means sales is 2400 and cost of goods sold is 1500, then gross profit will be 900. And in case of option 3, you can determine that the value of cost of goods sold is 750 and 800, that means total 1550, and the value of ending inventory is 700. In that case, the gross profit will be sales minus cost of goods sold, that means 2400 minus 1550, so the gross profit will be 850. So the question is, which one will you pick? It depends actually on the situation. Here, if it is possible to identify the specific item, then we can follow the specific identification method, and if a specific identification is not possible, then you have to follow another methods. Now the question is, what is a specific identification method? Under the specific identification method, a company can positively identify which particular units were sold and which are still in ending inventory. This method works best with limited variety of high units item. Here, the system must have records of original cost of each individual inventory item. For example, in case of selling cars or freezers, we can use this specific identification method. And where a specific identification is not possible, then we can follow either of the three methods. One is FIFO method, another is LIFO method, and finally the average cost method. Now I am going to explain what is FIFO method and what is average costing method. FIFO method assumes that the first goods acquired are the first goods sold. This results in cost of goods sold being charged with the earliest cost and ending inventory stated in terms of the most recent cost. The benefits or advantage of using this first in, first out or FIFO system is materials used are drawn from the cost record in a logical and systematic manner. This method is recommended where the size and cost of units are large, materials are easily identified as belonging to a particular purchase lot, and not more than 2 or 3 different receipts of the materials are on a materials cart at one time. Next is average costing method. Average costing methods assume that inventory valuation should be based on the average cost of all inventories available for sale during the period. A weighted average is used with periodic inventory system, and a moving average is used with perpetual system. The benefits of using average costing method is it is realistic costing method, useful to management in analyzing operating results and appraising future production. It minimizes the effect of unusually high or low materials prices, thereby making possible more stable cost estimates for future work, and it is practical and less expensive perpetual inventory system. Now I am going to explain the first method, specific identification method. For example, you have bought 3 different TVs at 3 different dates at 3 different prices. For example, you bought the first TV on February 3 at Taka 700. Then you bought the second TV on March 5 at Taka 750, and you bought the third TV on May 1 at Taka 800. On June 1, you have sold 2 TV at Taka 1200 each, so the total sales revenue is 2400. Now, under the specific identification method, you have to determine which units you have to sold. If you can determine that, then you can use this specific identification method. For example, under situation 1, you have identified that you have sold the TV which was bought on February 3 and another TV which you bought on March 5. So the cost of TV which was bought on February 3 was 700, and the cost of the TV which was bought on March 5 was 750. So you can determine the cost of goods sold is 1450, and at the end of the year you can determine the value of inventory at Taka 800, and you can determine the gross profit like sales minus cost of goods sold, that means 2400 minus 1450 equals gross profit 950. Then in case of situation 2, maybe you have determined that you have sold those TV which was bought on February 3 and which was bought on May 1. In that case, the cost of goods sold will be 700 plus 800. That means total cost of goods sold will be 1500, and gross profit will be sales minus cost of goods sold, that means 2400 minus 1500. So the gross profit will be 900. So a specific condition method is used when you can actually identify the unit which you have sold during this period. Now I am going to discuss about FIFO system under the periodic inventory method. Suppose Souls Distribution sells CDs of performing artist Ravi Chaudhary. At the beginning of October, Souls Distribution had beginning inventory of 2000 units of Ravi's CD with unit cost of Taka 7. During October, Soul made the following purchase of Ravi's CDs. On October 3, it bought 3000 CD at Taka 8. Then on October 9, it bought 3500 units of CD at Taka 9 each. Then on October 19, it purchased 3000 CD at Taka 10, and on 25th October, it bought 3500 CDs at Taka 11. At the end of October, total 3600 units remained unsold. And Soul Distribution uses a periodic inventory system. So as we have mentioned, there is 3600 units remained at the end of the year, so we have to determine the value of this ending inventory. So if we follow the first in first out method, then here we find that the total ending inventory consists of 3600 units. Now we have to determine the value of this ending inventory. At the end of October, we find that there are total 3600 units remain. That means these are ending inventory. Through calculation, we find that total goods available for sale is 15,000 units. Now we have to determine the total cost of goods available for sale. And if we sum the beginning value of inventory with the total purchase during this period, then we'll get the value total cost of goods available for sale. The value of beginning inventory is 14,000. The beginning inventory consists 2000 units and the value of each unit was 7. So the total value of beginning inventory is 14,000, and total purchase during the year was 1,24,000. So total cost of goods available for sale is 1,38,000. Now we have to determine the value of ending inventory. As we have mentioned, there are 3600 units remain as unsold at the end of the accounting period. So we have to determine the value of this inventory. As we have followed the FIFO method, so we can assume that this 3600 units comes from the goods which was purchased on 25th October at Taka 11 each, and the remaining 100 units come from the goods purchased on October 19th. So here the value of 3500 units will be considered at Taka 11 per unit. So the total value is 38,500, and the value of 100 units would be considered at Taka 10 per unit. So the value of this 100 units should be 1000. So the total value of ending inventory will be 39,500. And by this way, we can determine the value of cost of goods sold. First, we have to determine the beginning inventory with the purchase value, and the summation of these two items is 1,38,000, and it is called cost of goods available for sale. And then we can deduct this ending inventory that we have calculated earlier, 39,500, and then we can get the value of cost of goods sold, which is 98,500. Now with the same example, we are going to explain the value of inventory under the LIFO method. So here, as we have already mentioned, the total number of ending inventory is 3600, and as we are following the last in first out method, so we assume that the units which was bought lastly have been sold first. So these 3600 units consist of the goods which was actually included in the beginning inventory. You know, there were 2000 units at beginning inventory and the value of each inventory was 7000. So we can determine the value of inventory like this way. Beginning inventory 2000 at 7 Taka per unit, so total value is 14,000, and the value of the remaining 1600 units can be derived from the purchase which was made on October 3. So the value of this 1600 unit can be considered as 8 Taka per unit, so the total value would be 12,800, and so we can determine the value of ending inventory as Taka 26,800. And similarly, we can determine the cost of goods sold like this way: beginning inventory and purchase. If we sum the value of beginning inventory and net purchase, then we can get the value of cost of goods available for sale, and which stands here 1,38,000, and then we shall deduct this ending inventory from this cost of goods available for sale, and then we'll get the value of cost of goods sold, and here the value of cost of goods sold is 1,11,200. Finally, we can determine the value of ending inventory under the average method. Here, total goods available for sale is 15,000 units, and total cost of goods available for sale is taka 1,38,000. So we can determine the value of average inventory like this way. That here the total cost of goods available for sale is 1,38,000 and the goods available for sale is 15,000. If we divide this 1,38,000 by 15,000, then per unit cost will be 9.20. So we can determine the value of ending inventory like 3,600 into 9.2. That means the total value of ending inventory will be 33,120. And we can determine the cost of goods sold under this average method like this way. We should add the beginning inventory with the net purchase, and we'll get the cost of goods available for sale. And here the cost of goods available for sale is taka 1,38,000, and we shall deduct the value of inventory, that is 33,120, and we'll get the value of cost of goods sold, which is here 1,04,880 taka. Now I am going to explain the determination of ending inventory or value of cost of goods sold under the FIFO method for recording the inventory under perpetual inventory system. Here I am going to explain the valuation of inventory system under the FIFO method for the perpetual inventory recording system. Here the beginning balance of your inventory consists 800 units at taka 6 per unit. So the value of beginning inventory is 800 into taka 6, that means 4,800. Then February 4, you bought 200 units at taka 7 per unit. So the value of inventory should be like this way. 800 beginning inventory was 800 units at taka 6, that means total 4,800, and you have newly purchased 200 units at taka 7. So the value of 200 units is 200 into 7, that means total 1,400. So the value of total 1,000 units inventory is total 6,200. Then on February 10, you have bought another 200 units at taka 8 each. In that case, the ending inventory consists total 800 units plus 200 units plus 200 units, but their value is different. So we can determine the value of inventory like this way. 800 units at taka 6, that means total 4,800. Then 200 units at taka 7, total 1,400, and 200 units that you bought on February 10 at taka 8, and total value would be 1,600. So the value of total 1,200 inventories at the end of February 10 is taka 7,800. Then you have sold 900 units and you are following FIFO method. So you first discharge the items which you bought first. Now on February 11 you have sold 900 units. So we have to determine the value of cost of goods sold and value of ending inventory under the FIFO system. So we can determine the value of 900 units like this way. As we are following FIFO method, so we shall discharge the 800 units first, and then 100 units that was bought on February 4. So the value of goods sold or the value of cost of goods sold is 800 units at taka 6, that means total value is 4,800, and 100 units at taka 7, that means total 700. So the total cost of goods sold will be 5,500. And the value of ending inventory at the end of February 11 is or consists total 300 units, and the first 100 units, the value of first 100 units is taka 7, and the value of 200 units at taka 8. So the total value will be 2,300. Then you have purchased 400 units at taka 8 per unit. So the value of ending inventory at the end of February 12 would be 100 units at taka 7, that means total 700 taka, and 600 units, because the value is same, so we can add this amount 200 units plus 400 units, total 600 units. So 600 units into 8, that means total 4,800. So the value of total 700 ending inventory is taka 5,500. Suppose you have sold 500 units on February 20, and here we can determine the value of cost of goods sold like this way. Here under the FIFO method, we should assume that the 100 units that was bought at taka 7 should be sold first, and then 400 unit out of the 600 unit which was sold at taka 8 would be sold again. So the value of cost of goods sold should be 100 units at taka 7, that means total 700, and 400 units at taka 8, total 3200 unit, that means total 3900 unit, the value of cost of goods sold. And the value of ending inventory should be 200 because our remaining inventory is 200. So the value of inventory should be 200 at taka 8, that means total 1600 at the end of the February 20. Then on 25th February, you have returned 100 units from the factory to the supplier. So your inventory has been reduced. So the value of this return should be 100 units at taka 8, that means total 800. So at the end of this 25th February, you have only 100 units, and the value of ending inventory should be 100 units at taka 8, that means total 800 taka. Then finally, on February 28th, you have bought 600 unit at taka 9. So the value of ending inventory at the end of 28th February should be 100 units at taka 8 and 600 units at taka 9. So the value of total ending inventory under the perpetual method should be 6200, and the total cost of goods sold should be 9400. So with the same example, I am going to explain the determination of ending inventory under the simple average method for the perpetual inventory recording system. Here on February 1, you had beginning inventory which consists 800 units at taka 6. So the value of beginning inventory should be 800 into 6, that means total 4800. Then you have bought 200 units at taka 7 on February 4th. So after this purchase, your ending inventory consists of 800 at taka 6 and 200 at taka 7. That means total inventory is 1000 and total cost is 6200. So you have to divide this 6200 by 1000 units, and you will get the value of each inventory, which is 6.2. So the value of ending inventory should be 1000 at 6.2, that means total 6200. Then again on February 10, you have bought another 200 units at taka 8. So your total inventory is 1200, and the total cost of the value of inventory is 7800. So you have to divide this 7800 by 1200, and you will get the value of each inventory is 6.5. So you will determine the value of ending inventory 1200 at taka 6.5, that means total 7800. Then on February 11, you have sold 900 units. Then you can determine the cost of goods sold like this way. You have to determine the value of 900 units, which is 6.5 per unit. So you will multiply this 900 unit at taka 6.5, and you will get the value of cost of goods sold at taka 5850. And the ending inventory consists 300 units, and the value of each unit is 6.5. So the value of ending inventory should be 1950. Then on February 12, you bought 400 units at taka 8. So the total ending inventory consists 700 units, and the total value of these 700 units is 5150. So if you divide this 5150 divided by 700, then we will get per unit cost at 7.36. So we will determine the value of ending inventory like 700 units at taka 7.36, that means total 5150. Then on February 20, you sold 500 units. So you can determine the value of cost of goods sold of this 500 units like this way. 500 units, and the value of each inventory was 7.36, that we determined on February 12. So the total value of cost of goods sold is 3678, and we can determine the value of ending inventory like 200 units at taka 7.36, that means total value of ending inventory should be 1472. Then on February 25, you return 100 units. So 100 units will be deducted from your ending inventory. You have only 100 units at the end of 25th February, and the value of each inventory is 7.36. So the value of ending inventory is 736. Then finally on February 28, you have bought 600 units at taka 9. So the total inventory consists 700 units and the total cost is 6,136. So if you divide this 6,136 divided by 700, then you will get the unit value 8.77. So you can determine the value of ending inventory like 700 units into 8.77. That means total 6,136. And the value of total cost of goods sold in this case would be Taka 9,528. Now I am going to explain the impacts of using these different types of inventory valuation method in terms of income statement effect, balance sheet effect, and tax effect. If you check the value of ending inventory under the FIFO system, you will find that it was 39,750 and cost of goods available for sale was 6,01,300. So if we deduct the ending inventory from this cost of goods available for sale, we will find the value cost of goods sold at 5,61,550. So if we deduct this cost of goods sold from the sales amount or sales revenue, you will get the gross profit is 3,03,450. But in case of LIFO method, you find that the value of inventory was 34,300 and cost of goods sold was 5,67,000. As a result, the gross profit was 2,98,000 and under the average method, it was only 3,01,281. Then if we deduct these operating expenses from gross profit, then we will get the net operating income, which is 1,56,450 under the FIFO system and 1,51,000 under the LIFO system and 1,54,281 under the average system. Then we add other income, but there is no other income, so earnings before interest and tax remains the same value. Then we deduct the interest expense and there is no amount, so it also remains the same value. Then we deduct the tax, and the tax under the FIFO method is 50,064. Under the LIFO method, the tax amount is 48,320, and the average valuation method, the value of tax is 49,370. So if we deduct this tax amount from the EBT, then earnings after tax remains under the FIFO method as 1,06,386, under the LIFO method 1,02,680, and under the average method it is 1,04,911. So through this analysis, we can say that in case of price rising situation, the FIFO method gives the highest amount of net income and LIFO method gives the lowest amount of net income. That's why LIFO method is not permitted now. We just follow either FIFO method or average method. Now I am going to discuss about the next topic of this chapter. This is account receivable. And you know, account receivables result from sales on account or on credit. This may also result from credit card sales if there is a delay between when sales is made and when the cash is received from the credit card company. But at the end of the period, not all sales on account result in cash being collected from the customers, and as a result, a loss may arise. That is called bad debt. And we have two methods for recording this bad debt. One is direct write-off method, another one is allowance method. Under the direct write-off method, when a company determines a particular account to be uncollectible, it charges the loss to the bad debt expense. So the journal entry should be bad debt expense account debit, account receivable account credit. The matching principle requires that this expense be recorded in the period of sales, not the period when the account is determined to be uncollectible. On the other hand, the allowance method of accounting for bad debt involves estimating uncollectible accounts at the end of each period. This provides greater matching of expenses with revenue on the income statement. It also ensures that companies state receivables on the balance sheet at their cash, or that means net realizable value. So under this method, at the end of an accounting period, we also need to create an allowance or reserve for the doubtful account, that is bad debt expense, and allowance for doubtful debt account credit. At the time a particular receivable becomes uncollectible, then we shall give the journal entry like allowance for doubtful debt account debit and account receivable accounts credit. Sometimes a customer may pay the accounts receivable after it was written off. Recording the receipt of cash is always a two-step process in this case. First, the account receivable is reinstated, that means added back into the general ledger, and second, the cash is recorded and account receivable is reduced for the payment. So we need to give two journal entry. First, we need to reinstate the account receivable. So we shall give the journal entry like account receivable account debit and allowance for doubtful debt account credit. and when we receive cash, we shall give the journal entry like cash account debit and account receivable account credit. In case of determining the allowance for bad debt, there are two bases. One is percentage of sales basis, another one is percentage of receivables basis. In case of percentage of sales basis, it is based on credit sales to estimate bad debt expense for the period, and sometimes it is referred to as the income estimate method. On the other hand, under the percent of receivable method, allowance for bad debt is determined based on balance in account receivable, that means based on aging schedule, to estimate the balance at the period end, and it is called the balance sheet method. For example, the net sales for the year is 4 million and current balance in account receivable is 1 lakh, and in allowance for doubtful account is 300, and it has credit balance. Now we need to determine the value of allowance for doubtful debt at the end of the period. So as we have already mentioned, there are two bases. One is based on percentage of sales and another is percent of receivables. So under the percent of sales, assume that bad debt expense is estimated at 1/4 of 1% of net sales. So the bad debt expense amount will be 1/4 of 1% of 4 million. That means total 10,000 taka. So under this percentage of sales method, the adjusting entry at the end would be bad debt expense account debit 10,000 and allowance for doubtful debt account credit 10,000. So the new balance for allowance for doubtful debt is beginning balance is 300 and new balance is 10,000. That means total 10,300. But in case of percent of receivables method, we have to prepare our aging schedule first, and based on this aging schedule, we have to determine the value of allowance for doubtful debt. Here, through preparing this aging schedule, we have estimated that the total value of allowance for doubtful debt is 10,000. But remember that we have beginning balance 300 credit. So in this year, under the percent of receivable method, we should keep a new balance. As we have beginning balance 300, we should charge this year total 9,700. So here the balance of allowance for doubtful debt under the percent of receivable basis should be 10,000 at the end of the year. But remember that we had beginning balance which was 300. So we have to deduct this 300 from this 10,000 and we have to charge this 9,700 during this year. So the adjusting entry at the end of the year should be bad debt expense account debit 9,700 and allowance for bad debt account credit 9,700. So ultimately the balance of allowance for doubtful debt at the end of the year would be 300 beginning credit balance and 9,700 is new balance. That means total balance is 10,000. But under the percent of sales method, it was total 10,300. Now, what is aging schedule? As I have explained in the earlier slide that we have to use aging schedule. So what is aging schedule? The aging schedule is a tabular representation of all the bills and invoices along with their respective ages. That means the date on which this becomes due. Simply, all the receivables and bills payable are classified along with their date of maturity to keep a check on which payment or receivables is behind its due date and by how many days. The aging schedule is a tabular representation of all the bills and invoices along with their respective ages. That is the date on which this becomes due. Simply, all the bills receivables and bills payables are classified along with their date of maturity to keep a check on which payment or receivable is behind its due date and by how many days. An aging schedule is an accounting table that shows a company's account receivable ordered by their due dates. Often created by accounting software, an aging schedule can help a company see if its customers are paying on time. It's a breakdown of receivables by the age of the outstanding invoice along with the customer's name and amount due. Format of aging schedule is given in the slide. Let's solve a problem. For example, on July 10, you have received 75% of 20,000 balance owed by web company, a bankrupt business, and you have written off remainder as uncollectible. In this case, the journal entry should be cash account debit 15,000, allowance for doubtful account debit 5,000 and account receivable account credit 20,000. On July 15, the transaction was reinstated the account of zone company which had been written off in the preceding year as uncollectible. Now we have received taka 5,225 cash as full payment of Jones account. So here we have to give two journal entry. First one is account receivable account debit and allowance for doubtful account credit. Amount is 5,225. And you have to give another journal entry like cash account debit 5,225 and account receivable account credit total 5,225. Then on September 20, you have written off the 2,500 balance owed by Smith Incorporation which had no assets. So here the journal entry should be allowance for doubtful account debit 2,500 and account receivable account credit 2,500. On December 31st, based on an analysis of account receivable, it is determined that taka 11,500 will become uncollectible and the balance in allowance for doubtful accounts on December 31st prior to adjustment is taka 200 credit. That means we already have a balance 200. So in that case, under the percent of receivables method, we have to keep the balance taka 11,300 which will be calculated by deducting 200 from 11,500. So on December 31st, the journal entry should be doubtful debt account debit 11,300 and allowance for doubtful debt account credit 11,300. So in case of presentation of this account receivable balance in the balance sheet, we have to deduct the allowance for doubtful debt balance, that is 11,500, from the account receivable balance which is 62,000, and we should show the net realizable value which is 50,500 in the balance sheet under the current asset segment. But in case of percent of sales method is used to estimate bad debts, then assume that the total allowance for bad debt should be half of 1% of net sales, which is taka 2 million. So here total net sales is 2 million. So the allowance for doubtful account would be 2 million into 1% into half, that is 10,200. So this should be the ending balance of allowance for doubtful account. So in the balance sheet, we have to deduct this allowance for bad debt amount, that is 10,200, from the account receivable account, and the net realizable value should be 51,800 under the percent of sales method. Our next topic is note receivable. Note receivable is a promissory note and it is a written promise to pay an amount on demand or at a specific time, usually with interest. And here, if the note is paid according to the terms, the note is honored, and if the note is not paid as agreed according to the terms, the note is dishonored. And if the note is dishonored, the amount due, including the interest earned and unpaid, is recorded in accounts receivables. At the end of the accounting period, in order to comply with the matching principle, interest must be accrued for the number of days between the most recent interest payment date and the end of the accounting period. Let's discuss an example. On July 17, 2021, you have received a taka 12,000 90-day 10% notes on account from Abdullah Company. Here, due date for the note should be October 15, and interest earned during the term of the note should be taka 300, and 300 can be calculated like 12,000 into 10% into 90 days divided by 360 days. And maturity value of the note should be 12,000 plus 300, total 12,300. So at the end of the 90 days period, if the note is honored, the journal entry should be cash account debit 12,300, note receivable account credit 12,000, and interest revenue or receivable account credit 300. But if the note is dishonored on the maturity date, then the journal entry should be account receivable account debit 12,300, not the cash account, and then note receivable account credit 12,000 and interest revenue and receivable account credit 300. Let's do another example. On September 12, you have received a 30,000 12% 120 days note on account. So the journal entry should be note receivable account debit 30,000 taka and account receivable account credit 30,000 taka. Then October 9, you have received a 15,000 10% 60-day note on account. So again, the journal entry should be notes receivable account debit 15,000 and accounts receivable account credit 15,000. Then on November 15th, you have received টাকা 18,000 15% 3-day note on account. So again the journal entry should be same, that means note receivable account debit and account receivable account credit. Then on December 8 you have received the amount due on the note of October 9 with interest. So you have to determine the value of total interest revenue, and you can determine like 15,000 into 10% into 60 divided by 360 days. So the value of interest revenue would be 250. So the journal entry should be cash account debit 15,250, note receivable account credit 15,000, and interest revenue account credit 250. Then on December 15th, the note of November 15th was dishonored. So we have to determine the total interest revenue on this dishonored note. The value of note receivable was 18,000 and total due dates was 30 days. So the interest revenue amount should be 18,000 into 15% into 30 days divided by 360 days. So the total value of interest revenue is 225. So the journal entry should be account receivable account debit 18,000 plus 225, that means 18,225, account receivable account credit 18,000, and interest revenue account credit 225. And finally on December 31st you have to determine the accrued interest on the notes of September 12th. So the interest amount on this note can be calculated like 30,000 into 12% into 110 days divided by 360 days. As 110 days has been expired, so we have to put this value as 110 days. So the interest revenue amount should be 1,100. So the journal entry should be interest receivables account debit 1,100 and interest revenue account credit 1,100. In the previous example, we assumed that the accounting period was for 1 year. But now if we assume that accounting period is for 1 month, then you have to give the adjustment regarding the interest revenue at the end of each month. Here I am going to explain the adjusting entry that you have to give if you follow the accounting period for 1 month. Suppose on September 12th you have received a note amounting taka 30,000 at 12% 120 days on account. So on September 12th you will give the journal entry like note receivable account debit and account receivable account credit total 30,000. But as you are following the accounting entry for each month, so on September 30 you have to give the adjusting entry and you have to determine the interest amount on this notes receivable amounting taka 30,000. So here the interest revenue would be 30,000 into 18 days into 12% divided by 360 days. So the interest revenue should be 180. So the journal entry should be interest receivable account debit 180 and interest revenue account credit 180. Then on October 9 you have received another note amounting taka 15,000, interest rate is 10% for 60 days. So the journal entry should be note receivable account debit and account receivable account credit. On October 31st you have two notes, one is amounting taka 30,000, another one is 15,000. So you have to determine the interest revenue on these two notes. In case of 30,000 notes, the total interest amount would be 30,000 at 12% into 31 days divided by 360 days. And in case of note amounting taka 15,000, the interest revenue should be 15,000 into 10% into 20 days divided by 316 days. So the total value should be 402. So you have to give the adjusting entry at the end of October 31st like interest receivables account debit 400 taka and interest revenue account credit 402 taka. Similarly, on November 15th you have received another note amounting taka 18,000 at the rate of 15% for 30 days. So the journal entry should be note receivable account debit and account receivable account credit. At the end of November 30 you have to give adjusting entry which is interest receivable account debit and interest revenue account credit, but you have to determine the value of total interest revenue. Here at the end of November 30 you have total 3 notes. First note consists taka 30,000, the value of second note is 15,000 and the value of the third note is 18,000. So you can determine the total interest revenue like 30,000 taka into 12% into 30 days divided by 360, 15,000 taka into 10% into 30 days divided by 360, and then 18,000 taka into 15% into 15 days divided by 360. Then the total summation of this value should be 538. So you should give the adjusting entry like interest receivable account debit 538 and interest revenue account credit 538. Now I am going to discuss the last topic of this chapter, bank reconciliation statement. You know, bank reconciliation statement is a statement prepared by a business to match the balance shown in its cash book with the balance shown in the bank statement or passbook on a particular date. Even though both the business and the bank keep records of the same bank account, their balances may not match due to timing differences or errors. A bank reconciliation statement is a statement that explains the reasons for any difference between the cash balance recorded in the company's book and the balance shown by the bank. Here, in case of bank balances, we have two sources or two evidence. One is cash book, another is bank statement. Sometimes the balance of cash book does not match with the balance of the bank statement. The differences may arise due to many reasons, maybe due to outstanding check, unrecorded deposits, charges for services, interest and errors. So we have to reconcile these differences, and bank reconciliation statement ensures that what our books say and what the bank says are in complete agreement. Regular preparation of bank reconciliation statement reflects good financial management and internal control. Now I am going to explain an example for your better understanding. For example, the cash book of XYZ showed a balance at the bank of 570 in hand on January 1. At the same time, the bank statement balance of XYZ's account was Taka 446 overdrawn. The difference was accounted for as follows. That means I am going to explain the reasons of these differences. First issue is that check for 1,555 sent to creditors on 30 January were not paid by the bank until 8 February. That means we have deducted the balance from the cash book, but the amount has not been paid by the bank yet. So we have to deduct this amount from the bank statement of our balances. Next issue is check amounting Taka 2,520 deposited in the bank on 30 January were not credited by the bank until 1st January. That means the amount has been deposited in the bank, but it has not been recorded yet. So this amount should be added by the bank in their bank statement. So the amount should be added with the bank statement column. Then a standing order for a charitable subscription of Taka 60 had been paid by the bank on 21st January, but no entry had been made in the cash book. That means we failed to give any entry in our cash book. So we have to deduct this balance from our cash book. So we shall minus this balance from our cash book. Finally, the last difference was because of a check paid by XYZ for rent on 15 January for Taka 345, but it had been entered in the cash book Taka 354. Now, in case of cash book balance, we have to add this 9 Taka and deduct this 60 Taka from the ending balance shown in the cash book, that is 570. So if we add 9 Taka with 570 and deduct 60 Taka from the cash book balance, the balance of the cash book at the end of the month would be 519. And in case of bank statement, the balance was 446. Now we have to deduct this 1,555 and plus 2,520. Then the balance of bank statement would be 590. So the cash book and bank statement should be always similar. So that's all for this chapter. Thank you everyone.